Every now and then I come across a piece of information that almost feels like it should be illegal to know. Like I found a cheat code to the game of investing that seems too good to be true. This is how I felt a few years ago when I came across the holy grail of SEC filings, the 13F, a filing that money managers with over $100 million of assets are required to fill out, disclosing their US stock market investments every 90 days. Ever since then, on the 15th of February, May, August, and November, I sit down and take a peek at the trades being made by some of the most successful investors in the world. And this quarter, coming of course during the biggest stock market decline since March of 2020, there were some very interesting moves made by some of the investors that I watch closely, and today I want to share those with you. Hit subscribe if you enjoyed today's video, but let's just jump straight into it. Also, if you're looking for a tool to help you track the portfolios of money managers over time and then seamlessly dive into the financials of the companies that they're buying, then check out the link below to join Ticker. Ticker has a completely free account that you can sign up for, but if you do use my link down in the description below and at some point in the future you decide to sign up to a premium plan for more features, then you'll also be supporting the channel by doing so. So first of all, why should we be following investments made by these guru or these smart money investors? It's obviously because we can then blindly copy them in their investments, right? Well, no, that's probably not a good idea, and hopefully the word blindly indicates that. But on top of the obvious, there's a couple of key reasons why we actually can't blindly copy investors, even if we wanted to do so. The first is that 13F filings are delayed. So what we're looking at today is from the first quarter, from the start of January to the end of March. And the reason why we have to wait until May is because these smart money managers don't need to disclose their 13F filing until 45 days at the end of the quarter. So that means that for most money managers, particularly big ones that can move the market with their investment decisions, they're going to be waiting until the last moment to file. And for the first quarter, that is around the 14th or 15th of May. And the other two things to keep in mind is that, of course, businesses are dynamic. So it's not enough just to follow a smart investor into an investment. You need to know how to react to that investment over time, whether you're adding more when the stock is down or you're trying to get out of the stock, or how you should navigate that investment. And then the last thing is that the 13F filings only show us US equity positions. They don't show us international positions held by these investors, say in China or Turkey or wherever it might be. And we also don't get to see other types of asset classes like commodities and the cash that is in their portfolio. So it is kind of a limited view, but we do get to take a peek at some of the stock picks made by these investors. And ultimately, it's a good place not to copy investors, but to farm ideas. So to see what smart money is looking at, and if those businesses are in areas that you can understand, that are within your circle of competence, then you can dive into those businesses and figure out what do these smart money managers see in these companies, and maybe even if you don't invest in those companies, you can apply similar principles to other businesses in other areas. As I mentioned, there were a lot of moves made by smart money in the value investing space over the last quarter, but there's a couple of key things that I want to draw on, some kind of takeaways that I had from the overall trading activity from these investors. First of all, we have the clash of titans, which is the Big Short versus Warren Buffett. As I mentioned a couple of weeks ago in a video, Berkshire Hathaway during the first quarter made a lot of investments, and one of those investments was adding to their Apple position. Berkshire purchased 3.8 million shares for about $600 million, which, while that is an astounding amount of money, it only represents a 4.3% increase to the 800 plus million shares that were already held by Berkshire. And really, this just demonstrates Warren Buffett and Berkshire's continued confidence in Apple, which is now almost 43% of the Berkshire stock portfolio. But there's a famous investor who disagrees with Warren Buffett, and that would be Michael Burry of Scion Asset Management. Burry, of course, was famous for betting against the housing market before it collapsed in 2008, and he's taking another short position, this time against Apple. In the latest 13F filing, Burry's largest position, representing 18% of his portfolio, are put option contracts against Apple. Owning put option contracts essentially means that you're betting that a company's stock price is going to decline below a certain price over a certain period of time. And unfortunately, because we don't know the strike price, which would be the kind of determining price of whether he makes money on it, whether it's below or above, and the period of time, the expiration date on those contracts, because we don't know those things, we actually don't know what this contract looks like. In fact, some of these contracts may have actually already expired. They might have been 1 month or even 1 week contracts on Apple. Also, this bet is actually smaller than it looks, even though it represents 18% of the portfolio. That's just the value of the the shares that he has options contracts against. Essentially, each of those contracts probably cost him a small premium from maybe a couple of dollars to maybe $10 or $20 at the very most for each of those contracts, which means instead of it being about 18% of the portfolio, what he actually bet was probably a couple of percentage points, if that. So why is Burry betting against Apple, and why is Warren Buffett so heavily invested in the company? Well, I think the key difference here is that Michael Burry likes to take into account macroeconomic events that impact businesses in the short term. This is, of course, something that Warren Buffett does not consider in his investments. In fact, when there are macroeconomic events hurting the stock price of a business in the short term, it's often just an opportunity for Warren Buffett to add more to the position, which is exactly what he did during the quarter. But for Michael Burry, he's looking for these short-term events where he can make a profit on the stock price declining because of macroeconomic events. And the environment for Apple at the moment, and for a lot of businesses, but particularly Apple, has been very, very tough. There's, of course, rising inflation, which is increasing their costs. It's also hurting consumer confidence and the ability of consumers to spend money. And Apple, which does the vast majority of its manufacturing in China, has been very much exposed to these prolonged COVID lockdowns that the Chinese government continues to enforce. In fact, the problem with Apple's supply side in China has gotten so bad that Apple is now actually looking outside of China to build out manufacturing in a significant way to reduce their reliance. Particularly, they're looking in areas such as India. Now, it's always fun, I think, to watch what Michael Burry is doing because he makes some crazy short-term bets that seem to come out of nowhere, and certainly it opens my eyes to certain events going on in the world, but it's not really the way that I like to trade. I'm much more aligned with Warren Buffett in that if there is short-term macroeconomic events hurting a stock price, I'm likely just going to add more to that business. But another approach I have when it comes to 13F filings is to think about the areas that I'm interested in, and particularly the areas I'm invested in, and to see what smart money is doing in those areas. Are they buying the same businesses I am? Are they buying competing businesses? And kind of dissect what smart money is doing in the areas that I'm interested in investing in. And one of those key areas for me at the moment is the streaming wars going on between Netflix and all of the other legacy media companies. And during the quarter, there were a lot of trades made by institutional investors on Netflix and the other legacy incumbents that are competing against Netflix in the streaming space. So starting from kind of least noteworthy, working our way up to some that I think are really important to watch. Pat Dorsey added to his Disney investment. He added 54,000 shares, bringing the investment up to 10% of the portfolio. But as you can see, Dorsey actually added to almost every stock in his portfolio, so clearly he's taking the recent market decline as an opportunity to buy more of the companies that he already loved. We then have David Einhorn, who added to his Warner Brothers Discovery investment, increasing the position by 150%, so it's now 2.6% of the portfolio. Warner Bros. Discovery is, of course, the recently spun off merger between Discovery and Warner Brothers, which was spun off from AT&T. And within those two massive studios, there's also other key studios such as HBO. And now this new business that just really finished their merger a couple of months ago is essentially now a pure media play. It's still a legacy media company, but it's a pure media play with these studios, and they're clearly spending more and ramping up their spending in the streaming space. To stay on Warner Brothers, Michael Burry made a significant investment in Warner Bros. Discovery. He bought 750,000 shares, making it about 10% of the portfolio and the third largest equity position. And then we have Berkshire. Yes, Berkshire Hathaway invested in Paramount Global, which was previously Viacom CBS. This is another large media company with key film studios such as Paramount, Showtime, Comedy Central, Nickelodeon Network. These are massive media assets. And again, it's another kind of pure media company streaming play that's moving into this space. Clearly Paramount Plus is kind of their flagship product that they're just ramping up right now. So you can see we've got these smart money investors making some interesting moves around the legacy media companies, particularly Paramount, which I think has a price to earnings ratio of 4 or something insane. But on top of all of these moves, which were relatively smaller moves or made by people I don't really follow all that closely, not Warren Buffett, I of course follow him closely, but it was a small move from him. There were actually two distinct moves that I thought were really, really interesting to watch. Bill Ackman invested over $1 billion into Netflix. And looking at Bill Ackman's 13F filing is a perfect example of why you can't blindly copy institutional investors into positions, because what we also know now, thanks to Bill Ackman, he didn't have to disclose this, but he did. He actually sold out of his Netflix position in Q2, completely and took a $400 million loss. In a press release, Ackman spoke about how the new potential ad-supported tier and the projected subscriber loss for the next quarter for Netflix's earnings, both kind of combined with some other factors to make the business no longer projectable, that he could no longer figure out reasonably what the future cash flows of the business might be. In my view, I think that's code for Bill not getting what he wanted, which I think was a one bad quarter, quick turnaround, and the management team plowing money into share repurchases during that decline, which is two things that obviously didn't happen. The management team is not doing share repurchases because they're focusing on the underlying business, and it looks like the subscriber loss problems are going to continue at least for the foreseeable future. But then the other interesting move came from the Sequoia Fund. The Sequoia Fund is a portfolio within the Ruan Cunniff and Goldfarb Investment Management Company. Why do we care about this? Well, Bill Ruan, one of the founders of this investment company and the Sequoia Fund, is actually was a lifelong friend of Warren Buffett. In fact, they met at an investing seminar run by the one and only Benjamin Graham. And when Buffett closed his Buffett Partnership Investment Company in 1969, Buffett actually told his clients to invest their money in Sequoia Fund. And for 45 years, the fund has generated a 15% per year return, significantly above the 11% per year that the S&P 500 has delivered over that same period. The Sequoia Fund made a few changes during the quarter. They sold 100% of their Disney investment and also almost doubled their Netflix investment, bringing it to 4.5% of the portfolio. In a portfolio update earlier in the year, one of the managers of Sequoia, Trevor Magyar, explained the decision.
We paid particular attention to two areas. The first is the competitive situation, and then the second is the international opportunity. And there we looked at current penetration and looked at the sort of penetration potential. We've seen the emergence of various streaming competitors. Most of them are really the linear incumbents at long last, finally reacting in earnest to the market that Netflix pioneered. And I guess at the highest level, we accept that the emergence of competition could have some bearing on Netflix's growth rate in a given quarter or even over a longer period of time. But the idea that the emergence of competition has somehow caused Netflix to go X growth from a subscriber perspective is not one we believe or accept. I'll take this back to the investment thesis, which is that streaming is going to be a giant global market, and that scale here is going to be incredibly important. And what that means is you're going to end up with a consolidated market. The next one is interesting. So international opportunity. At this point, over half of Netflix's subscribers are already overseas. And the question is, can they continue to grow that base? And the reason why that's an important question is they're already quite penetrated in the US. Maybe not fully penetrated, but quite penetrated. And the punchline is that we still see considerable opportunity for Netflix to grow its subscriber base overseas. We sourced most of the funds for the Netflix ad from our position in Disney, which we exited during the quarter. We just saw a very significant mismatch in terms of the attractiveness, the relative attractiveness of the investments. And so we moved funds from Disney to Netflix.
In essence, he believes that Netflix is well positioned to benefit from this global growing streaming business, and that relatively speaking, Disney was far more expensive compared to Netflix. So it was kind of two parts. One is that they obviously believe Netflix is a great company, and then relatively speaking, it was a much better investment. So they sold their Disney position and used that money, as well as some other money from selling Prosus as well, to fuel and fund this Netflix investment. Now, of course, since Q1, we've had an earnings release from Netflix, and we saw what happened. It was terrible, and the stock price collapsed even more sharply, and that caused Bill Ackman, to get out of the stock. So the question is, did Sequoia act in the same way? Did they just hold their Netflix position, or were they contributing more to it in the second quarter? That's something we won't know until either the 13F filing for next quarter comes out, so in 3 months' time, but likely before that we will actually see the portfolio update from Sequoia on their website. So that's what I'll be watching out for, to see what they did with their Netflix investment. But those were some of the key takeaways that I had from the 13F filings. If you enjoyed today's video and the format that I chose today, rather than just going kind of one by one down the biggest picks from investors, I kind of wanted to pick some categories that I thought were interesting to make this video a little bit different. If you enjoyed that, make sure you leave a like and let me know down in the comment section below. But with that said, hope you guys have a great week. I'll see you in the next one.